we invest in software companies, and obviously software is driving innovation in businesses and efficiencies, and that's across all different industries. We're generalists. We invest in all different verticals, so we've looked at some deals in the association space, which is how I met Ben. Picked his brain from time to time on tangential companies, and that's kind of how I've gotten involved and started poking around in the area. Typically, venture capital is investing much earlier into a huge market, okay? And so they want a great team and they want a huge market that they can go after and turn a company that's, a couple $1 million in revenue into a multi-billion-dollar enterprise value business, can return their entire fund multiple times and just can be that rock star winner. And so when you look at the association market, some of the challenges you're going to have is if software is small ticket items to some of these associations, does it have the market size to really be that huge business? And the bigger your fund is, the bigger the market you have to invest into. And so some of these large funds have ignored some of these smaller ticket softwares in the association market. But if you're a smaller fund like Cofounders is, maybe it's a market size that you can really attack and own and invest in a software that provides real value. And so when we look at some of our softwares in the association space, we were saying, okay, maybe there's some neglected areas here that we can attack because the market size is enough. But the other thing, I'm kind of generalizing here, but the other thing about the association market is you get so many at-bats from a sales opportunity. There are associations popping up all the time. There's a huge number of them. There's a whole range of sizes that you can go after. So if you're trying to segment the association market with a specific software, community platform or whatever you're looking to do, there's different segments that you can go and attack and see if you're relevant in that space. So if there's a lot of point solutions in the association market, which there are, one thing that you would see a private equity doing is trying to create a platform kind of play, which is, hey, we're going to take this one company, we're going to have it be at the core of our system, and then we're going to bolt on these point solutions around it. And so, now all of a sudden that software that's selling isn't selling at a $10,000 a year into an association. They have so much value that they can create with the bolt-ons. So they're the core centerpiece of what runs that association, and maybe now they're worth $50,000 or $100,000. So because of the way PE can acquire and piece together these different entities, they just essentially increase the overall market size of each one of these point solutions. You might have a solution that serves a purpose for smaller agencies or smaller associations that couldn't afford the behemoth in the space, right? And then you add functionality where you can kind of go up market. We see that a lot of times, which is, hey, this association, and I don't know the price points of every software in the association market, but they need a community platform and they just can't afford the big behemoth in the space because it's $100,000 a year. But here's another solution, right? And that solution is going to keep meeting that customer's needs where now they can start selling on market. That's an easier thing to do because you get more customer validation, you get more market penetration. You can cash flow your business from the software side. You can cash flow it as you're trying to go upstream. What's really hard is getting a comprehensive solution that you can sell for 6 figures or 7 figures into a huge association out of the gate, because they probably already have solutions that are servicing their different needs, right?
I try to get this feedback pretty regularly.
Entrepreneurs come and pitch me all the time. That's not what pisses me off. That's my job. Deal flow is my job. But how transactional sometimes people can be with some of these, like, hey, here's my business. It's awesome. There's no way it can fail. I need you to write a check. And by the way, in the next couple of weeks, could you commit to investing? The reason it pisses me off is, like, we say no. We meet with and look at like thousands of opportunities a year. My team does. And so we say no 99.5% of the time. But our job is to maintain a brand and a reputation, deal flow, conversations with entrepreneurs while we say no 99.5% of the time. And it's really hard to do that when someone expects it to be so transactional and so quick and everything. When they genuinely understand they've done their homework. They understand that they're a fit. They understand that there's an ask for money, like an investment opportunity. There's an ask for introductions. There's an ask for advice and feedback. There's an ask for, like, there are a lot of positive things that can come out of the conversation rather than an investment decision, like a positive investment decision. And so what do I like? Like, what's great? Like, understanding that all those things are a win. How do we best utilize this 30 minutes of time we have? Not, it's just going to be if you tell me in the first 5 minutes that it's a no, like, this conversation is a waste of my life, right? So.
Can you talk to us a little bit about putting a fund together? Like, what does that look like from the VC side? Because I think people think you just show up magically with money, right? I mean, isn't that the case? It's just the money.
So our first fund. So the reason I think I got a job and got hired is David realized it's a lot harder to manage other people's money than it is your own. When it's your own, you can do whatever you want. This deal looks good. I really like this entrepreneur. I love this space. Even if I lose it, maybe I'll create some good in the world. It's your money, like, whatever. But when it's other people's money, right, you have a fiduciary responsibility. And so then all of a sudden the diligence, the scrutiny, the legal review, like, all of it, it's serious. And so we went from a $12 million fund in 2015, and then David and I together raised the second fund, which is a $31 million fund. And for that $31 million fund, we had 600 first meetings. I repeat that, 600 first meetings to try to raise that capital. Okay. There's a lot of stuff on the day-to-day that overlaps, and you guys, they should be empathetic. And the best time, by the way, for an entrepreneur to go hit a VC is after they've been on the road, like, fundraising, like, for like a year, because it's like the soft shell turtle, they call it, like, or the soft shell crab or something. It's like they're the most vulnerable they'll ever be, because they feel so bad for you to have to go fundraise that maybe you can catch them on a weekend. Right now, I mean, the hot button is AI, right? Like, AI is embedded in everything. I'm sure AI is going to be embedded in association communication, right? Like, engagement of, like, association members and what that looks like. And I think that there has to be real scrutiny. There's got to be real scrutiny on solutions that are in the market as to, is this a real technology, or is this a thin wrapper around, like, a publicly available, open AI that, or ChatGPT, that, like, you can kind of do on your own and figure out how to optimize. What's the real value you're getting from a software provider that's just throwing AI out around there? And so I would challenge the folks making decisions on how to implement stuff like that. Like, do a little research. Like, what could you do on your own? What kind of value are you getting? Is it a real technology solution, or is it, like, a proprietary technology solution, or is it something you can kind of get on your own? So those are kind of pitches around AI, and not business cases solving real world problems. Spidey sense, right? Tingling. If I get we're such a great development team. Like, we spun this up overnight. We spun this up over the weekend. Spidey sense, right? Okay, what's the defensibility? Like, when it comes time for someone to acquire this company, and it's a build buy decision, why wouldn't they just build it if it, like, no offense? So that's the kind of thing. So I always say, entrepreneurs, this is a bit of feedback, like, start with business problem. There's a real business problem. There's a real need for efficiency. There's a technology that can solve that problem, like, and make it more efficient. And AI is a great piece of technology in your proprietary stack that helps solve that problem. So if an association were to come and say, okay, this technology is venture backed, right? I'd say, okay, what's the expertise of that investor? How deep were they looking at other competition? How deep were they looking at substitutes in the market? I mean, substitutes are a lot different than competitors, right? Excel spreadsheets, like, you all know associations that probably manage their members on Excel spreadsheets and Google Sheets and have emails and all that stuff, right? Like, we see that. Excel spreadsheet is a real substitute to a lot of solutions that are on the market. So when I would say look at competition, but also look at substitutes that are out there, what have those investors looked at? Why do they think that this is a differentiating technology And then the other thing is like, how durable, I guess, is this business going to be? Like, do they really have real financial backing? And do they have a? This is hypocritical coming in and investing in like true startup companies, because a lot of times it's fake it till you make it. But I'm saying, like, these are questions you should ask, which is oftentimes why we as a VC say we got millions of dollars back behind this company. They're not going anywhere, right? So those are the most important things to look at.
I'm ready for it.